Good afternoon, everybody. It's Doc here from OnTheMoneyOptions.com and Coastal Capital Management, and it is Monday, May 7th. Today I want to share with you a losing position, which turns out to be a good losing position. And I'll explain that. And first I'll define what a good loser is. A good losing position is a position where you have defined your risk up front, and before anything happens, you know the absolute worst that can happen. So here's a situation. In this business, it's impossible to be 100% right. You pick the best stocks that you can, you make good positions in them, and you protect them. This is the reason why we hedge. This chart is Fluor Corporation, a great company in the industrial sector, and over the past few months has been making a nice strong move up, and it looked like it was going to do very well through earnings. But earnings came out 3 days ago, and it really disappointed. It was a surprise disappointment, both on their revenue and their earnings. Since then, analysts have downgraded it, and the stock has really taken a tumble. You can see here, if you look at this chart, that on recent activity late last week, it was trading around $60, and today it closed at $44.42. So if you're long this position, you're down $15, $16 from the high, and that would be some real concern. Now let me show you how we've handled it. What we've done here is that we look at this support, this level right here at the $55 level, and this is what we consider a support level that we wouldn't want to see it break through. So this is where we set our protection. So what we've done to protect this position is that over time that we've owned it, we've moved our puts up, our protective puts up to the $55 level. So let me show you what is the result of that. Let's look at it with the hedge separated out. You can see here that we entered the position at $61.32 and it traded last at $44.50. So the stock position itself is down considerable. Now this is a 1,500 share position, and you see that it's down $25,000. Now what we do in our portfolio is that we look at 10% as a maximum amount of risk that we want to take in any position. So when we bought the stock at $61.32, we bought a protective put at the area that is nearest to a 10% below that price. So what we have here is we have a 55 put. We also sold a 62.50 covered call. And as you can see, that the combination of these two are, or our hedge as I like to call it, our hedge is worth $15,742. When you look at the stock position, it's down $25,000. Now let me put the two together so you can see what I'm talking about. In this pane, you can see that the total position, it cost about $92,000. It's down $9,519. So it's right on our 10% level. You can see that the May 62.50 covered call is pretty much worthless now. It's worth a nickel. It will go to zero, and we'll make the whole $1,222. Now what's really important about this situation here is that we can wait. We know the worst that can happen. We're looking at it. We have made puts, so we've got about 3 weeks to determine whether or not FLR is going to turn around and come back up, or it's going to stay down and we're out of it at $55 a share. So being out at $55 a share is a whole lot better than being out at $44 a share. So anyway, this is how we hedge. This is why you hedge. And I wish you happy trading. And remember, stay hedged.